There are many differences between Islamic banking and conventional retail banking. And those differences are very important to basically for the general people to understand, because many of them are confused because they see pretty much the same outcome, the same financial product offered by both. However, there are very important differences that we should note regarding the operation of Islamic banking or Islamic retail banking in general. First and foremost is the structure of the Islamic bank in comparison to the conventional bank. Islamic banks, they have an extra layer of governance, which is basically formed by the Sharia Supervisory Committee. It's a committee consists of at least 3 scholars. Those scholars are basically well experienced and knowledgeable about Islamic finance and Sharia in general. The committee is an independent committee. They don't report to anybody in the bank or the board of directors or the management committee in the bank. That's to ensure their independence. And if anything that is not in compliance with Sharia, the committee will not allow it. In addition to the Sharia Supervisory Committee, there is the Sharia Compliance Department in the bank. The Sharia Compliance Department in the bank basically oversees the day-to-day operations of the bank and advise the management of the Islamic bank on the day-to-day operations of the bank. Any Sharia issues will supervise basically the bank as a whole, will provide solutions and will ensure that there is a control mechanisms or framework for each department in the bank to ensure any Sharia non-compliance risk is managed in the best possible way. So this is very important in terms of differences between Islamic banking and conventional banking, and this structure doesn't exist in conventional banking. The other main difference in the structure is basically the source of funding for Islamic banking. The source of funding should be strictly from Sharia compliance source of funding. This, for example, the share capital, the capital of the shareholders, or the deposits of the customers who are depositing their money with the bank for the bank to invest it and then share the profit with them. Or it could be based basically as well on banking placements, where Islamic banks deposit money with each other for basically to invest that money. So that's the source of funding should be fully in compliance with Sharia, and the business activities undertaken by the bank, the investment undertaken by the bank should be all in compliance with Sharia. And that's another difference with basically conventional retail banking. The other very important point regarding this issue is basically the whole premise of Islamic finance is to offer a solution for the society, an ethical solution that is basically in compliance with Sharia and based on socially responsible basis in terms of trade, sharing the risk in the process of providing financial products. And that's what underpins Islamic finance and Islamic banking, and mainly the principles that financial products offered by Islamic banking or Islamic banks are based on. And that you see it basically in the differences in the contract that's used by conventional banks, which is basically a lending agreement, interest-based lending agreement. However, Islamic banks, they use different Islamic financial principles to offer their products. And those principles are mainly based on risk sharing, where the risk is shared between or among different stakeholders within the process or the parties to that contract. Unlike conventional banking, where the risk is basically one party is responsible for the risk, in this case would be the customer, and if there is a risk for the bank will shift this risk in different ways, by taking insurance, doing different interest swap agreement, for example, buying options, which is forbidden in Sharia, etc. Basically using different other agreements that are not permissible under Sharia. Islamic banks, they don't use that. Basically, the core aspect of the principles used by Islamic banks is either profit sharing agreement or a profit and risk sharing agreements, where the risks basically shared according to the steps and the stages of undertaking basically the transaction in the Islamic bank. Another important point is every product offered by Islamic banks is asset backed. So there must be an underlying asset for any financial transactions undertaken by the bank in offering their products and services. And that's a very important point, unlike conventional or traditional banks where basically it's just a lending agreement. The bank lends the money to the customer and charge them rate of interest. Islamic banks, on the other hand, they basically undertake trade either by purchasing a commodity. There must be an asset in order to justify that specific financial transaction, and the conditions for undertaking that financial transactions should be fulfilled by the Islamic bank, and that's a very important point. To illustrate this point further, I would give an example for financial products offered by Islamic banks. Basically, if we take a savings product, which is usually based on either the Mudaraba principle or the Wakala principle of Islamic finance. Mudaraba is profit sharing agreement where the bank and the customer basically share the profit generated from the investment. The Wakala principle is an agency agreement where the bank basically employs its expertise in order to invest the customer's deposit or the customer's fund and generate profit for an expected rate of profit. So if you see how the two Islamic finance principles work in comparison with conventional banking, where basically the customer will be lending their money to the bank, depositing their money in the bank and taking interest for their funds. In Islamic banking, basically the bank and the customer will act as partners in that process. The bank will use the customer's funds to invest it in the market, buying different assets and selling it for a profit, then basically sharing the profit with the customer. For example, in the Mudaraba, there must be a profit sharing ratio agreed in advance. Let's say, for example, 50-50 between the bank and the customer. So whatever profit is generated from that investment, it will be shared 50-50. It's not a fixed profit. The bank can basically give an indicative profit rate that could be generated, but the actual achieved or accrued profit will be shared between the bank and the customers according to the profit sharing ratio. So the customer may take profit more than the indicative or the expected profit rate at the end. And that's very important difference between Islamic banks and conventional banks, because whatever conventional banks, whatever return they generate, they will just give the customer that fixed or specified interest rate on their funds. So that's another point regarding this, basically, is the risk is shared between the bank and the customer. The bank is actually undertaking economical process in terms of purchasing commodities, selling this commodity, and making profit by using the customer's fund, then sharing the profit with customers. If we take another example in terms of offering home purchase plan, home finance product. Typically, this product is based on the diminishing musharaka agreement or diminishing co-ownership agreement, and lease agreement, ijara agreement. The bank and the customer jointly will purchase the property chosen by the customer. So both of them will own the property, will have joint ownership of the property, and will assume the risk associated according to their share in that property. In order to allow the customer to use the whole of the property, which is the aim and the objective of this transaction basically, the bank will lease its share in the property to the customer for an agreed rental payment. Over time, the customer will be making monthly payment. The payment will consist of an element, which is the rent element for renting the bank's share in the property, and another element to purchase the bank's share in the property over the finance term. At the end of the finance term, the customer will basically own the property outright. So that's basically joint ownership between the customer and the bank in order to allow the customer at the end of the finance term to own the property outright. And as we know, the difference is between the Islamic banks and the same product offered by conventional banks, as known, which is basically known as mortgage, is in terms of the conventional product, the bank will be lending the money to the customer and charging the customer interest. So the bank doesn't assume any risk and doesn't get involved in the process of purchasing the property, unlike the model offered by Islamic banks in terms of basically offering these financial transactions to customers. So going back to the point I raised in the beginning, it might appear to many people the outcome is the same, but the process and the underlying transactions are completely different. And that is what basically give this importance and distinguish Islamic finance from any other basically methods used by traditional banks to offer similar products.